Good morning, everybody. Thanks very much for joining us. Really super panel this morning, looking at the Netherlands investment markets, what the outlook for this is, particularly coming back from the summer, a lot of activity growing in the market, and so it'll be really interesting just to get a sense of exactly what's happening in the market and where we see the outlook. Super panel here. We have Rogier, who's head of real estate finance for Benelux at Berlin Hip. We've got Peter Helfrich, who's managing partner at Primevest Capital. Tia van Beek is director of transactions, the Netherlands for Principal Real Estate, and Jaap van der Bijl, who's CEO for Altera Vastgoed. So a really nice mix of both finance, but investment and looking at different sectors as well. So a lot of interest here. For those who don't know me, my name's Richard Betts and I'm the publisher at Real Asset Media, and we produce around 60, 70 of these events. We're also a partner on the Senior Housing and Healthcare Association, and as well as running RealX.global as a kind of virtual fair, we're also have the International Investors Lounge at Expo Real and MIPIM. So do look out for those if you're going to Expo Real especially. But let's start, Rogier, let's start with you. Just a kind of minute on yourself and the company.
Yes, thank you, Richard. Good morning, everyone. My name is Rogier, 49 years old, father of three. I'm heading the Berlin Hub Benelux office. Berlin Hub is in the meanwhile the largest non-Dutch lender in the Netherlands on real estate. Active since 13 years with a very diverse real estate portfolio for a large group of institutional clients, high net worth individuals. Doing well, very proud on that, and happy to participate.
Super, thanks very much, Rogier. Tia, coming to you.
Yeah, Richard, thank you so much, and thank you for having me on your panel. My name is Tia van Beek, and I'm a director of transactions at Principal Real Estate. Principal Real Estate Europe is part of the Principal Global Investors dedicated real estate business, and we manage and sub-advise 97 billion in real estate assets globally. And the group's real estate capabilities cover all four quadrants, encompassing public and private equity and debt investor solutions. In Europe, Principal Real Estate operates from 8 offices, employing more than 100 staff who manage real estate across all asset classes in 9 different countries. And we sponsor and manage our own funds like the Principal European Core Fund, Eurozone Durable Income Fund, Office Fund, Hotel and Data Center Funds. And we also invest via and or manage for separate accounts. ESG and digital approach is incorporated in all our investments and an important criterion for the investments.
Yeah, and that's certainly a topic we'll be picking up today as well. Jaap, coming to you, just an introduction of yourself and Altera.
Yeah, let's introduce Altera first. And first of all, it's great to be on this panel. Thank you, Richard, for the invite. And hope we can, come across with a good information and insight on the Dutch market. Altera is a real estate manager for institutional investors. We cater domestic and international investors. We focus on residential and convenience retail, managing 2.7 billion at this time. I like the platform. I joined the platform in 2016. It's coming up to 5 years. One of the cornerstones, a few of the cornerstones of Altera is we focus on quality and prime core. We focus on efficiency. For instance, the total expense ratio is 30 basis points for the manager. We focus on ESG. We'll probably talk more about ESG during this webinar.
Super, thanks very much. Peter, let's come to you, and also congratulations on the new role at Primevest. So it would be interesting to for those who don't know a little bit more about Primevest and yourself.
Yeah, thank you, Richard. First of all, thanks for your invitation. And indeed, not so long in this new role, and a lot of things still to learn from the company, and a lot of energy and a lot of things to focus on also going forward. And we really want to grow this company into something which is hopefully will be a very clear and company to look for in the industry. Primevest Capital Partners. Maybe I joined indeed as managing partner here. Primevest Capital Partners is an investment company mainly for the institutional market, although we have some retail clients as well. And together with our investors, we really strive, or we're investing in real assets. We strive to make cities more prosperous and more thriving. And we do that by investing together with our investors in smart mobility, connectivity, and livability. So that means in our case, we are very large in parking, we are large in the residential sector, and we are very large in the glass fiber sector. Together with our investors, we really have a smart city program, as we call it. And we hope to make sure that these cities get more prosperous and livable in the future, and in the near future, hopefully as well.
Great, that's super. I just wanted to pick up a little bit. Let's start with you, Rogier, just in terms of, I suppose, how you're seeing the market at the moment. What's your sense of the key themes for you, I suppose?
Well, the key things for us are like the others, so that's starting to become sustainability, of course, and digitalization. Having said that, the market is currently relatively slow, in my view. There's obviously more than enough liquidity, but there seems to be low supply of product. Everyone is looking for core products at the moment, and everyone owning those is not really eager to sell those because they don't know what else to do with their money. So it looks like the market is a bit less active than last year. Having said that, there's a lot going on. If something comes to the market, like a nice residential portfolio, like a nice supermarket portfolio, like a nice life science park, many investors are bullish to buy it.
Thanks very much for that, Rogier. Let's pick up with you, Tia, in terms of the market. What have you been seeing, I suppose, and I guess how do you see that from the investor's point of view?
Well, yes, I have to agree there with Rogier. Selling your assets is something. It gives you a certain dilemma because, of course, you can sell, but what will you buy back? We do see opportunities. But there is this great urge for core assets. So you have to look carefully. There are opportunities, and maybe forward funding, forward purchasing provides you with a little bit broader perspective on what you can do. And so we also focus on that right now.
Okay, super. Peter, just coming to you, it would be really interesting, I think, I suppose, just to get a sense of, I suppose, where you see, risks in the real estate markets at the moment. I mean, is a key risk for you the continuation of the health crisis, or do you see that as being, are there political risks, economic risks? I suppose, what are you seeing at the moment?
Yeah, probably all of the above, Richard, which doesn't make it life easier right now. But yeah, indeed, I mean, we are, or you could argue, do we come out of a health crisis, or are we still in it? I mean, the judge is out on that one, but hopefully we will. At least we have seen some relief, and I guess we will see more relief going forward. But it is an extremely interesting market. What we have seen due to the house crisis, of course, is a jump in online sales, which helped the logistics and industrial sector a lot. Residential wasn't touched so much, but if you look at retail and then and mainly the non daily good retail, except for the supermarkets, that is then maybe we see that already. We saw a decline in physical sales before the crisis, which has accelerated during the crisis. And the question now is how do we come out of that? Is the trend converging? Do we see some stabilization in that market, or are we going maybe in an accelerated way what we have seen before the health crisis? Politically, obviously, I mean, every country is different also in making sure that these reliefs are there. So travel is still, if possible, it's still quite a nuisance. So It refrains people from traveling. You see the hotel business suffering from that and the touristic industry suffering from that. So yeah, there's a lot still to overcome, and we still have to see how we are going to deal with these risks. And I think that's also the reason what Rogier said, that we see a little bit quieter market in that sense, and that people are still, every investment manager is still looking at what's his long-term value in this field. And that's never easy, but certainly in this area or in this period, it's more difficult than before.
And I suppose, Jaap, from your point of view, what are you seeing in terms of, I guess, investor confidence, whether that's domestic investors, but also international investors looking at the market?
Mm-hmm. First of all, they have a lot of capital on board, so they're looking for good opportunities to invest, which is already mentioned also in this panel. Is there investable stock available? They tend to follow the core approach to their investments, which we cater, for instance, with an income play on both residential and convenience retail. They are picky, they are selective. The due diligence is quite extensive, and that makes perfect sense to us. What we see is that there's a difference between going single country, single sector, or a pan-European approach. It depends on who you are and what your risk attitude is. We've been quite fortunate to be able to attract some international investors for our specific strategies, given the quality of it.
Okay, good. Sorry, Peter, did you want to pick that up?
No, sorry. No, I'm okay.
Excellent.
Risks. You were mentioning the risk, Richard. I think businesses are struggling with the post-COVID recovery. Some businesses will have some fallout, trying to reboot their business. Applies, I think, mostly for within the retail space for the comparison side of retail, which is challenging in itself in the Dutch market.
Okay, good. Just coming to you, Rogier, just in terms of the, I suppose, the demand from your side, are you seeing more borrowers coming to you? Again, is that international? What's your sense of investor demand in a way, and demand for finance?
Well, there seems to be, as said, the market is a little bit slower than normally, but fortunately, competition is healthy. So even though I have the feeling that our margins tend to go up a little bit, the market seems to be well balanced. It is for everyone, as said, supply is scarce, so people are looking for the better assets, and so do we. And so criteria now also for us it doesn't have to be just core. It's not just on the right location, but the product we finance has to be attractive. It has to be a nice place to be. That applies also following the pandemic for offices as well as retail, especially. If people do not want to go there, they might not go there because there's a digital alternative, and perhaps we would also not be interested to finance it. That, of course, does not apply for the housing sector, and I think most of us share that view. So yes, market seems to be a bit smaller, even though there is enough liquidity, both from investor side as from bank side, but I believe everyone is a little bit critical on what they are investing into.
I'm going to drill down a little bit into the sectors. Maybe let's start with you, Tia, and then of course if anybody's got any views on this, do please come in. But Tia, let's start with you with offices, because different views on office in general, and certainly the views have kind of moved from one way to another over the last 18 months. But what are you seeing at the moment in the market, I guess, in the Netherlands, and what's your sense of the office markets going forward?
Well, I think before the pandemic, you already saw a shift in offices, grade A offices and B and C offices, and that's in line with what Rogier just mentioned. It's about the location, the type of office, the sustainability of the office. Is it a well office? And to give you a nice example, just pre-COVID, we bought the Helix office in Utrecht, which is designed by Paul de Ruiter, well known for his well concepts. And during the pandemic, I think we all tried to figure out what would happen to the office market. And what we saw here is that because it is a well office, it is on a hub of public transport. It has a nice environment with a lot of facilities surrounding it. It was well leased up during the pandemic because of these factors. So it's very critical in the office market that you invest on locations that are easy reachable by public transport. But the office itself should also be, well, let's say, pandemic proof. You have to be able to reach your floor by staircase instead of an elevator. So we will see a shift there in the type of offices people like to work in. And the floors will be differently divided. I think the offices where everybody would be packed together with little desks, that's not attractive anymore to companies to work in. Also to attract young talent, I think it will not be that interesting. That will mean that B and C grade offices, and then we're talking about accessibility, location type of offices, will be less sought after. So there will be there will be a segregation between these offices.
Mm-hmm. Yeah, no, I fully agree. I would only add that, of course, there's a lot of health focus right now, right, on these offices, and people are. I mean, I think in Holland we were already quite flexible in providing employees with the opportunity to work from home, which is different in other countries, right? I mean, that you have seen certainly here. But I think right now it's because you see a lot of employers struggling with how do I get my people back actually to the office, and what does it mean to be in the office versus being at home. And although we somehow all strive and want to be at the office after 1.5 years sitting for most at home, it's still, the judge is still out of how does that balance look like? When are you in the office and when are you at home? And we all know that meetings, live meetings like this, we are sitting here. I mean, we didn't do that 1.5 years ago. I mean, it was virtually, it was not there. And all of a sudden we know all these apps and it's getting better and better, Richard. I mean, we see ourselves now, it's beautiful. But still there's that to be creative, to get ideas. You need that interaction and the interaction via live stream, although much better than the telephone, it's still second to meeting live. So there's a lot of work to be done in terms of, okay, how does that balance look like? When do I need people in the office and how do you really get them there? And that means that you have to be extremely attractive as an employer, and not only as a company, but also as a physical office provider in that sense. So it will be interesting to see.
Yeah, no, that's good. Yeah, go ahead. Yeah.
Yeah, I think quite right. The office is changing to a meeting place for creation and social interaction. That's one side effect of the corona crisis. The other impact this working from home has is also on residential. We see people looking for more square meters because they know they are working from home during a couple of days per week. And they need some space and silence, especially when you have young kids. And you need your private working facility there. That's interesting in itself also, but it reflects to the residential market, and we'll probably talk some more about this later on.
Okay, great. I've got a question come in from Liber Vincent. Thanks very much for joining us, Liber. Are core office assets still attractively priced, since financing in the Netherlands tends to be 100 basis points more expensive, so returns are not competitive? Does anybody have a view on that, either in terms of the returns or the financing side? Feel free to pick that up or respond to Libor later, whichever you prefer.
Quickly, but I would say, fair pricing, that's always a question, but it's the demand versus the supply in the market we face. And I'm not so inclined to look at leveraged yields. Of course, it's very, you're very eager to do so because of the low interest rate environment we are today. But somehow, there are also pure equity investors out there who look at an equity return and not a levered return. So that's foremost always in the focus of our attention. What is the actual return on the asset without leverage? And I think we are somewhere. It's in my world pretty fair price, but that has to do with the fact that our risk-free rates are so extremely low. So there's still a healthy premium to find in investing in these assets, as long as you keep your value stable, of course, over time, at least stable, that is.
Yeah, if I may add to that, if in the current capital market situation, the price of the leverage is, let's say, blocking an investment because of the leverage yield, then indeed the asset might be a little bit too expensive.
Okay, interesting. I wanted to pick up on some of the other sectors as well, but we can come back to the office side. But I was interested to know. I mean, Jaap, obviously you've been working in. You mentioned there the sort of convenience grocery retail side. So there's been a lot of focus on that area, particularly of retail. So it'd be good to get a sense of how that's working and what the prospects are in terms of the Dutch market, but also maybe your broader view on retail.
Okay, a lot of questions in there. So what we've seen throughout the COVID crisis is that convenience retail, as in the Netherlands, is very deconcentrated with a supermarket or a convenience shopping center, or almost just one click away from everyone's home, booming. And we also saw that in the rental collection, there were hardly any problems on that side. So strangely enough, we were not waiting for this, but COVID presented an evidence of, let's say, the core nature of the convenience retail. It's also situated in residential areas, so it's very predictable in its own. And giving this, what I already mentioned, this working from home, that's a supporting driver to that. So we're quite pleased with the results we've had on the convenience portfolio. We also have a smaller comparison portfolio, and we're concerned about the comparison retail market, as there's too much square meters, and also there's the competition for the online channel on that side. So we've chosen some, even before the crisis, to go for the convenience retail because it's more stable, it's more predictable, and you have good anchor tenants in case of supermarket retailers. And we strike deals with them. And it's also very helpful to enhance the ESG of a neighborhood shopping center. These flat roofs, you can install solar panels. So there are a lot of things in there which I think are very helpful, at least for us and for investors who are looking for that type of exposure. It's an income play.
Okay, interesting. And Tia, from your perspective, how do you see those retail markets? Because obviously there's been a huge amount of negative sentiment. Do you see that beginning to turn a little? Is the position different in the Netherlands?
I don't know if that in January is turning, but we like retail actually. So it's like Jaap says, you have to be careful where you select your retail and what type of retail. But we believe that once a retail center is a real center to a neighborhood or to a town, then it's pretty interesting to invest in right now. And maybe because of the slightly negative sentiments the sector has had, this is a moment to invest in it. And well, honestly, we see nice results and we see huge resilience in the retailers themselves. Their creativity and their determination is endless. And what I also found, but maybe because I have 3 daughters, that we like to go physically shopping again. We missed it, honestly, and I think I'm not the only one. So, well, I'm sitting here maybe in the wrong panel, I don't know, but
No, you're not.
It's something it's very recognizable, actually.
No comment.
No, but it tells us something about what we think of retail. We missed our shops, didn't we?
Oh.
So, and of course, let's not underestimate online. It is a factor. It's there to stay, but there will be a new balance.
Yeah.
The scary thing I find is that the online bills seem to have stayed as high, but now physical shopping bills seem to have come in as well.
Yeah.
Recognizable.
More boxes at home.
And Peter, do you have a sort of positive view on retail or not? What's your position?
Yeah, I mean, I tend to be rather positive, so that's a danger. But I mean, it seems extremely well priced, right? That's the problem, that's the real opportunity we see. On the other hand, that it's about the sustainability of the rents. And there's something to say that they're still too high in many areas. And the problem with retail is if you pay more than €1,000 per square meter, the alternatives are not there, right? Yeah, they are there, but it means that you have a huge decrease of your values in these assets. So, I mean, in the smaller cities, you also already see that conversion. So there you see living in shopping streets. I mean, on the one hand, we lack housing, so that should have been an easy match with empty shops on the one hand. And as you are in the city center, that seems to be very attractive. But you need to come down from pretty high rents to more normalized rents on the residential sector, and that's a stretch. But you see in smaller cities where the rents are already down, you see that conversion starting, and you see that. I think we all agree that shopping streets will be more compact, and it will be focused on a more dense area. But the question is, how large will it be, and what are the alternatives there? And in a city like Amsterdam in the Kalverstraat, it's not. You have to come down from pretty high levels to transform that to residential space. So I think it will take a long time still to sort of come to a more stable nature of the supply of retail space in the Netherlands. But that means also there are very many opportunities right now as well, because some have already come down or some have better alternatives in there.
Mm-hmm. And Rogier, are you seeing, I mean, are you seeing, I suppose, more lending requests in this area? Are you seeing a difference in terms of, I suppose, what you're lending on, the types of different retail?
Yeah, obviously retail is one of the most diverse asset classes that I know. What we have done, you may have read it in the press recently, is financed mostly convenience retail. Also, our retail portfolio is dominated by supermarkets and convenience. That is also, fortunately, where still requests are coming from. What we do see is that retail actually works well. As Tia said, I've got two daughters. Once the sun shines, they go outside and they start shopping, and many people do so. Even when the shops were closed, the city centers in the Netherlands were quite busy. The question is, as Peter said, what are the sustainable rent levels going to be? Because attractive retail has to be blended with residential, but also leisure. And I have no clue yet how much rent a traditional coffee shop can actually afford. They might not be at the same level as a large retailer in the Kalverstraat, as you mentioned, and that makes it a little bit challenging. And that is mirrored in the large spread in yields that we see. Some people pick up shopping centers for 10 times the rent, and others pay 5%. And there are obviously reasons for that. Institutional investors might step into the, let's say, lower yielding product. But I also see many investors hiring retail specialists in order to acquire those and to see where the upward potential is. And that upward potential may be in, let's say, rebranding the shopping center, or in expanding via resi developments, or adding other services. So it's super interesting, actually. Having said that, we remain cautious and try to follow those investing in convenience.
Okay, good. Libor's just come in as well on the comments side, which is, is mixed use assets the solution for retail assets? And that's actually quite that's quite an interesting thing. I mean, how do we see this in terms of the sort of mixed use, mixed assets, that kind of side, particularly moving into that view on livability in cities as well. Will we now begin to see retail as instead of seeing retail as something that is a bit of a dinosaur and may have to die, to seeing it as something that is actually crucial for more of a living city approach?
Okay, who wants to pick that up? Mixed use is interesting in itself, but there's not one clear concept of that for inner cities. What we do is we take out retail square meters and build out residential. And that's mixed use on its own. because we cater a number of target groups: the young, the old, the families, which is good for the inclusion in a city and also the inner city. I think most of the ideas regarding mixed use will be circling around. Let's have a retail shop and add some food and beverage or restaurants or activity to that. Still remains to be seen whether that's the best concept you would have on mixed use. We're more interested, logically, given our nature and our business, in adding social infrastructure next to residential and adding some convenience retail. That's a better mixed use feeling. But it's open for discussion, I guess.
Maybe
it always is.
Yeah.
Maybe I could add something. You could compare mixed use maybe to what happened in the station areas and 90s. In the evening, mixed use puts the light on. If people live there, it makes an environment more interesting, but also more safe. So you might remember the malls we had where there was only shops there. That at 6 the lights go out and there's nothing. So in that way, mixed use provides livable cities, and Peter, I think that's your area of expertise. But that's what we like in the end.
Oh yeah, I think you're absolutely right. Yeah, I mean it's in the old days. I mean, look at how institutional investors worked, right? You were either investing in retail or offices or residential, and it was hard to sort of find the allocation for mixed use because you were always sort of polluting then their idea of, oh no, I'm invested in retail. Right now it seems much more, if you look at really look at the long term, then you will see different cycles, right, for different sub asset classes. And I think Tia is absolutely right. If you look at land values, and that's maybe the primary way to look at it, and for 50 years, then it's kind of a diversifier, right? If you have alternatives, so then it's even more about the location and the alternative uses of the location and looking beyond the current use of that location. But like we said, I mean, coming down from rent levels in A1 retail streets, I mean, it's extremely hard to find an alternative which can provide you with the same kind of direct income. So yes, it depends, of course, on what your starting point is as an investor. In making it interesting to have mixed use there, but I think in general, I mean, land values will be higher if you have different alternatives for uses. Yeah.
Yeah, no, I think that's interesting. I wanted to pick up a little bit on residential, because that was one of the ones that was, mentioned, and of course across Europe has been a huge topic. How are we seeing the residential markets at the moment? Rogier, let's start with you, and just a reminder to everybody as well that please feel free to put questions in either the comments or the Q&A area, and I'll make sure that we pick those up and answer your questions for certain. So Rogier, I suppose, how are you seeing that residential side?
Well, first of all, our new business at the moment is dominated by residential loans. It's still a super secure asset class, also because, of course, we do not leverage 100%. So despite the current interest levels, values might even go down a little bit. And as a senior lender, you could still be relaxed. Having said that, there are a couple of threats to keep in mind. Of course, interest levels to start with yields we see today, there is not a lot of headroom left for interest to go up. And secondly, regulation, including sustainability regulation. As a resi investor, you might expect some mandatory investments in your assets for the future to make sure that your portfolio remains sustainable, which is and can be quite costly. So more and more the budget of making a portfolio greener is becoming a heavier covenant in our loans. That does not just apply for resi, by the way, but since the yields are a bit tighter on resi, it is starting to become a challenge. We see a couple of different kinds of resi coming to us over the last few years, actually, which are converted offices, which can be very attractive, and sometimes they're not. It also relates to the development of the area. Is it an attractive place to be? Can you go outside, etc.? Secondly, the forward funding transactions Tia mentioned. If you want to have a young portfolio consisting of new and green buildings, well, you might want to be forced entering into forward funding structures, and we see quite a few of them. And we see portfolios which are a bit older and need those sustainability investments. I think that characterizes the market at the moment.
Okay, good. I definitely want to pick up on some of those areas around ESG shortly. But who else has got a particular view on the residential side?
You know, for the audience, I think, Richard, it's good to know that there's this huge and persistent mismatch between supply and demand. That we have some good demographic drivers, and although it's a sweeping statement by the politicians, we need 1 million new housing in 2030. Some of it's correct, so you should focus on the new build market. So the forward funding is correct, and also focus on that. Also tying in the ESG requirements. That's what we do. And we'll probably talk some more about ESG, but we're quite fortunate to have a very young portfolio, average age of 2010. We're number one worldwide according to GRESB. So in terms of CapEx to comply to this ESG regulation, as Rogier mentioned, we have this roadmap up and ready and running because we only have 100 months to comply to Paris proof regulation. This 100 months, that's a nice little keyword in there, because that sounds a bit shorter in timeline than one would expect. 100 months, counting down right now.
Okay, good. I'm going to come back to the residential. Let's pick up that point about ESG, social impact, purpose-driven investment, because that's been a kind of growing theme particularly over the past 2 years, accelerated, I think. Peter, just what's your perspective on that?
Yeah, I mean, in my world, you can only have one perspective. I mean, we have to comply with that, right? And we have to somehow go to a net zero carbon emission, and rather sooner than later. And we're all part of that. The only problem I see, that space starts to be commercialized as well. And you almost have to be, I mean, you have to be an academic almost to understand exactly where these pollution is coming from, and what is the real contributor or the main contributor to pollution versus things which are very nice to do, but doesn't really move the needle in that sense. So I'm desperate always in looking at independent data on that sense, in how can we measure and how can we improve on that measurement. And the interesting part is that I always find if you really want to contribute, we should be buying very old stock, right? Because I mean, the built environment is the one which is causing the trouble, not the newly built environment. And that's the interesting part, right? We're all scrambling for, you hear it here, forward funding, making sure that we buy these green assets. But the problem is actually in the very old assets where we have to invest in. And that's what Rogier said. A lot of social housing corporations are struggling with that because they have these levies, so they say they don't have the money. And if you have an old portfolio, I mean, it will kind of erode part of your return. So that part in my world, because we all know this is a main contributor, that should be more subsidized than it is today. And you can argue and you can talk for hours about how that should be subsidized, but and optimized as well in terms of subsidization. But that's somewhere I think what we have to be looking for, because I think 99% is out of the existing stock and not out of the new stock of the pollution.
Yeah, and sorry. I mean, that would be interesting to pick up your view on that. from your perspective, when you're looking at sustainability, are you looking at, for example, repositioning assets, or is that more about new stock? What's your sense of that? Because embedded carbon, for certain, will become more of a challenge, I think, in the industry.
Well, first of all, I'd like to say our organization has been in ESG since the 90s. So, and what you see right now, it's become a little bit of a buzzword, and it should be a real thing. What we noticed is that since a few years, everybody should be aware of their environment. That's a clear thing, and it's how you approach it. So, what we do as an organization, we have new assets, we have existing assets, and we measure each year, and we invest to improve. And I think that's what ESG is all about. So you have in your new buildings, of course, it has to have a certain level of sustainability, obviously. And into older buildings, you measure and you improve, and that's asset management. So ESG should be incorporated in the whole organization and not just be a momentum that you use when you buy a new building. So we have very strict rules on how we implement ESG in our portfolio and in our organization, and that's the best way forward, I think. And to add on to what Peter said on social housing, I do think a lot of corporations in the Netherlands who own 40% of all houses do invest also in sustainability and measures improving the sustainability of their portfolios on top of the levy they have. And that is a quick win, because there's a certain control or a certain pressure as a government that you can put on a large amount of houses in the Netherlands. And so it's a combination, I think. Above all, if we want to get to the Paris standards, as Jaap says, we only have 100 months left. So it's hands-on for all sectors.
Okay, great. Rogier, thanks very much for your question. I'll come to that in a minute. Rogier, go on.
I would like to step in on Peter's remark on buying all the buildings and make them green. Taxonomy is the biggest challenge when it comes to ESG, because there are too many labels. There's a lot of regulations. Various institutes are pushing down regulations to investors and consumers, which is, by the way, a good approach. Having said that, we have 3 targets. We'd like to have a 1/3 green portfolio in 2025. We try to create transparency by translating all these labels to CO2 output. But most important, we are offering our clients transformation loans, and which is not a transformation loan from an office to an apartment building, but which is meant to make brown buildings greener. Having said that, I mean, we have a loan book of north of 23 billion. So if we can make that portfolio greener, then we can really contribute. That is why it is important for us. It also means that investors need to have a business plan and a budget of how to achieve this greener buildings. And what we note, it also relates to a very diverse attitude to sustainability, is that such a budget or such a plan is not always available. So we really have a big leap to make there.
Okay, good. There's around 15 minutes left. Jaap, did you want to come in on that?
The only thing about the ESG, Rogier mentioned the taxonomy. So actually, the G is overlapping the E and the S. The G is creating ESG as a topic of risk management. Comply or not, ticket to the game or not. I think Peter's also very right regarding the existing stock. And therefore the suggestion of Rogier with this transformation loans, that's very interesting. Because then you can, work on that while maintaining the affordability of the residential, because that's the S thing in ESG. You can invest in it, but it has to stay affordable for your tenants.
Okay, good. Let me drill down a little bit into that sort of affordable housing side and some of those other sectors like senior living. also to a certain degree student housing, those kinds of things that come a little bit more into that impact investment side as well. So Peter, I know you were keen to speak on this, so maybe just try and pick up some of that as well, that sort of slightly alternative investment side as well.
Yeah, no, I mean, as I told in my introduction, that we are looking at smartening cities, and one of them is the mobility issue. We all see parking garages as they were used to be, inner city or outer city, but mainly inner city, and you drove your car in there, and you went to your office or you went to your shopping street, etc. And we see now that in terms of making sure that our cities are future-proofed. You see already that in many cities we try to get the car out of the city, but that means something. I mean, that has a direct impact on mobility, because where do you go with your car? Even if it's self-driving or electrical, you have to go somewhere, right? And it has to be parked somewhere, and it has to be charged somewhere. And hopefully you can then combine certain other alternatives with parking your car somewhere. So next to charging, you can make sure that it's a mobility hub. So you come in there and you either take your bike or you go by foot to your destination area. You can think about making sure that it's used as delivering your groceries or other packages to the same area. So that's a very interesting part, but that means something for the city and the infrastructure of the city, and it means something for then you have a kind of a ring-fenced city where people come and go out of it again, and move on from the garage to the mobility hub center. Another part where we're very much interested in, and you see it more and more, is making sure that we smarten up also our lamppost, for instance. You see even more there. It's kind of a very dense area where you have electricity already. They're there. So apart from LED lights and things like that, and making sure that there are sensors which go on and out only when it's necessary, you can charge your car there, or use it as a 5G network, or make sure that it has sensors to look at pollution in cities and movability in cities, and make sure that you can look at congestion and how to avoid congestion there. So I think that's the real asset story we are very interested in, and we try to bring our investors into that story, because that's something which is innovative, and we all know that we have to go there, right? It has to be optimized how we deal with our cities and our livability of our cities going forward.
Yeah, there's a definite linking there between the sort of digital infrastructure side and the built environment, and how that's going to work together in terms of cities. Jaap, I just wanted to pick up with you, because I know that behind you, I believe, is a senior housing development there. What's your sense of the senior housing side, particularly there in terms of the Dutch market? You mentioned that there was a lack of demand in terms of overall residential. Is that the same case also in senior housing? And
yeah, it is. So if you look at the market and you have these three target groups, the young, the families, and the seniors, not the old, seniors. You see that the seniors are overrepresented as owner-occupier in this market, but they need maybe some life cycle housing as they mature, and we're entering this baby boom retirement phase. So people will be looking for new housing which is not there. So it's very good to focus on senior housing and have that market, so people will move out of those single family houses, creating new opportunities for families. Then you get the flow running in the housing market. It has to be affordable, given the fact, for instance, we invest on behalf of pension funds. We know in general what the average income is once you are retired. So it has to be somewhere in the ballpark between 750 euros and 1,200 euros per month. And it should be decent, high quality accommodation. You would like to live there because you're moving out of your single family house. It's a very interesting market. The numbers are huge because I just mentioned this baby boom generation retiring now. We're slowly progressing to 1 in 3 65 plus citizens. So that makes it a massive market, and it's very helpful also to solve the congestion in the residential markets. Especially, we also focus on the young, because they are, let's say, the outsider on this market. They don't have the means to go to any social housing corporation. They have an earning 10-year waiting list. They have, not enough to buy a house. The average housing price now well above 400K, which is difficult for young people. So they should be in the non-regulated rental sector. And again, between the 750 and 1200. So it's a generation all-in type of strategy.
Okay, good. A couple of big sectors that we haven't covered yet. So just briefly on these. Tia, maybe coming to you first on the logistics side. Last time we were looking at the Netherlands, particularly, there was an expectation of a sort of Brexit bounce that was beginning to happen in terms of the warehousing side. I guess, what are you seeing in the market at the moment? Is the outlook as positive as everyone was expecting kind of 6 months ago?
Yes, honestly it is. Logistics is still, big box logistics is booming. To the point that you think, where do we reach a certain overheating? If you look now at the yields, it's extremely sharp, far under 4 for grade A logistics. And what you see there, a lot of big boxes have been constructed, parties have been moving. You might even wonder, are we seeing the same signs here as we've seen in the office market just before the great financial crisis? This said, it still means we need logistics. And apart from that, and that's in line with, I think, what Peter says, the cities that are getting more ring-fenced, we see a new trend as well, which is last mile logistics, last mile delivery, because the cities are difficult to reach right now and will become more difficult to reach. So you see around the ring-fenced city, you see a ring of smaller logistic boxes. So we see a shift, which is maybe a little bit different than we had expected 6 months ago. The question is, of course, Brexit has an impact on it, or is our consumer behavior influencing it? And I think it's more the last and the first, honestly. But still, yeah, I think it's one of the most favored asset classes that we have right now.
Okay, good. And Rogier, in terms of the financing side, let's just pick up on that. And also a word from you as well on the financing of hotels and leisure, because obviously, again, just beginning to see the leisure kind of travel markets come back again.
Well, to start with logistics, I confirm that my opinion is also that it's of course a good asset class, but it's a bit overpriced in my view. Hotels is a bit different. Fortunately, our hotel exposure is relatively small, and unfortunately, it will take a while until the hotel market will pick up again. So I believe that it's worthwhile having a look at it, because there is a future out there, but there is a business plan, and that business plan should take some time. It's not gonna recover within a year or so. That will take a while. Leisure is becoming more interesting when added to retail, as we discussed. As we said, it has to be a nice place. Retail has to be a nice place to be, and leisure contributes to that. That I believe is a bit different than you might know.
Okay, good. Peter, any view from yours on the Primevest side there?
No, yeah, I mean, as said, logistics, looking at land value or residual value, yeah, it seems very expensive. I agree. On the other end, there's a lot of demand for logistics, and that's probably going to continue even after the COVID crisis. So somewhere that will continue, I guess. But one day there will be quite some oversupply, and then the world might look differently as well. But it's interesting, right? I was just thinking, we talked about ESG and how to reduce carbon emissions, and I think we know number one is that we buy too much stuff, right? Together, I mean that's the real pollution part. And if you look at, I mean, that's so contradictory on the one hand, right? That we built all these logistics to get all these goods delivered to your home, and they all come by different cars, different. It's not really optimized for sure. Everybody who looks in their streets might see 5 different or 10 different suppliers in one day, going door by door. It's a crazy world if you think about it, Richard, sometimes.
I just wanted to pick up on a question that came in from Rogier. So will office yields become much lower as the vacancy rate is historically low? Small development pipeline and redeveloping office in secondary locations are being transformed into residential. So is there an opportunity there in terms of the office side? Is that anybody's view? What's your sense of that?
I think the transformation took away a lot of offices that were not really suitable to be an office, but that has been done over the last several years, and I think the most interesting offices have already been transformed into residential. So the offices left now, you have to wonder if nothing changes there to the built environment, are they suitable for transformation? Because not every location is a good residential location. And so that said, I don't know how much impact that will have on grade A yields in offices. But I do believe that transformation has been very important to the office market. For example, The Hague, we saw a refreshment of the office market where they took out around 400,000 square meters, and it really helped the office market there. It also helped the residential market.
Yeah. Okay, great. Just on one thing as well, in terms of the cities, obviously most people are very familiar with the main Dutch investment cities. But was there any move, with this work from home to people looking at smaller cities, and has that introduced kind of more of an opportunity maybe for some of those smaller cities, or is it really going to revert back to the norm and everybody's going to be back investing in Amsterdam? Does anybody have a view on that?
I think there will be, we see some differences already, but I think it will take some time. I think the example is in the US, Los Angeles, where you see more and more companies having satellite offices on different sides of the city to make sure that you connect, that you still can connect with your employer, but not necessarily have to go all the way to the city center. And I think hopefully we will get there, because we are sitting here, but this was the first 2 days today was actually real congestion again on the streets, and nobody wants to be in there again, right? So we have to find something there.
Yeah.
I believe a nice place to work is not necessarily on a CBD location, and I think many people appreciate a green environment to work in, and I mean literally green, perhaps even close to a forest. And it has to be, of course, well accessible by several means, and of course not just by car, also by public transport. But again, it has to be a nice place to be, and it looks a bit like quality of the asset and attractivity has gained a little bit from location. So it might not just be location, but it might be location, attractivity.
We're almost out of time here, so I just wanted to just pick up on a kind of last question for everybody. So out of all of these things, I guess, where are we seeing the fundamental opportunities at the moment if people are looking with I suppose quite a long-term view on the Dutch market? Where are you seeing the opportunities and the market moving, I suppose? Let's start with you, Peter.
Yeah, I mean, for me, very clear still on the housing side, and then both traditional student housing, co-living, senior housing. I mean, we all know we have a shortage in supply, and it's across all the uses there. The only but there is the higher regulation we're facing, which provides instability, and nobody likes instability. And when it's not predictable, it's tough to invest in for some reason. So there's a plus and a minus there, but in general, that's the main asset class for me.
Okay, great. Rogier.
Yeah, buy land and build houses, or perhaps buy redevelopment positions in the worst case, because you might then also take out some browner buildings out of the office stock and retail stock. I think that's an opportunity, and also very important for our society.
Okay, great. Tia.
Yeah, adding on that, because I fully agree with Peter and Rogier on the housing side, but I think convenience, rightly positioned together with leisure, absolutely interesting to look at. Last mile, obviously, in line with the same trend I think we see there, and still offices on super hubs of public transport.
Okay, great. And last but not least, Jaap.
Oh, sorry. Well, first of all, Richard, thank you for this great webinar. As for anyone who would reach out to the panelists, feel free, and also maybe we have an opportunity to see each other during the expo. Coming to your question, yes, residential, yes, convenience retail, go for the young, go for the old. Those are the main target groups. Build as quickly as you can. Look into temporary housing also, which is a good alternative to liaise with housing corporations and municipalities. That will be, depending on your risk attitude, my takeaway.
Okay, super. Thanks very much. Really interesting discussion, and thank you also to everybody for your questions and comments. I hope we managed to answer those in the time available. We will indeed be at Expo Real, and we'll be looking again at the Netherlands market there. And there will be some sessions, particularly around senior housing as well, student housing. A lot of these issues will be covered as well. So if you are at Expo Real, do come to the International Investors Lounge in Hall A1, where we're running a program over all 3 days there. There's also a session tomorrow morning at the same time, which is on senior housing and healthcare, particularly looking at the comparison between the more established markets and some of the more emerging markets in Europe in that sector. And there was a lot of discussion as well today around the digital and communication side and bringing cities together. And on Thursday morning, we've also got a session which is linking the infrastructure and built environment together, but particularly looking at data, digital, telecom. So if those areas are interesting, all you need to do is, just like you did today, is walk into the RealX auditorium, click on live stream, and you'll be in the discussion. And for those watching it on demand, all of those sessions will also be available on demand as well. Thanks very much for joining us. You can connect with one another in the platform. You can do video calls, you can do all of those things. You can also have a look at the virtual exhibition on your way through. But thanks very much for joining us from me, and thanks very much to the panel and you for joining. Thank you, everybody.
Thank you. Bye-bye.
Thank you.